Have you ever wondered why a stock suddenly stops falling and starts moving up? Or why it reaches a certain price, struggles to go higher, and then drops again? Is it just luck? Not at all. In the stock market, these price levels are called support and resistance. And they are among the most important concepts every trader and investor should understand. Whether you're trading stocks, Forex, crypto, commodities, or indices, knowing where buyers and sellers are likely to step in can dramatically improve your decision making. In today's video, you'll learn what support and resistance really mean, why prices respect these levels, how to identify buying and selling zones, common mistakes beginners make, and how professional traders use these levels to improve their entries and exits. Let's begin. What is support? Imagine a rubber ball falling onto the floor. The floor prevents it from falling further and makes it bounce. In the stock market, support works in a similar way. Support is a price level where buying interest becomes stronger than selling pressure. As the price approaches this area, more buyers enter the market because they believe the asset is available at a good price. As demand increases, the downward movement slows and often reverses. Think of support as a buying zone, not just a single price. For example, suppose a company's stock has fallen several times to around 100. Each time it touches that area, buyers enter and push the price back up. Eventually, traders recognize that around $100, buyers consistently appear. That area becomes a support level. Support represents confidence. It tells us that buyers are willing to defend that price. However, remember one important thing. Support is never guaranteed. If selling pressure becomes too strong, support can break. What is resistance? Now imagine the opposite. Throw a ball upward toward the ceiling prevents it from moving higher. Resistance works the same way. Resistance is a price area where sellers become more active than buyers. When prices reach this level, many traders begin taking profits while others open short positions. The increased selling pressure often causes prices to stop rising or even reverse downward. For example, suppose a stock repeatedly rises to 150, but every time it reaches that level, sellers appear and push it back down. Eventually, traders notice this pattern. The 150 area becomes resistance. Resistance is considered a selling zone. Again, remember that resistance is an area rather than an exact number. Prices may briefly move above it before reversing. Why do support and resistance work? Many beginners think these levels are magical. They're not. Support and resistance exist because of human psychology. Financial markets are driven by fear and greed. Imagine investors who bought a stock at 150. The stock falls to 100. Months later, the price climbs back toward 150. Many of these investors decide to sell because they simply want to recover their money. This creates selling pressure. Now imagine another group of investors who missed buying the stock at $100. When the price returns to that level, they see it as another opportunity. They start buying. This creates buying pressure. As thousands or even millions of traders think similarly, these price levels become important market zones. The market remembers, and traders remember, how to identify support levels. Finding support isn't difficult once you know what to look for. Step 1. Look for previous price lows. If the price bounced from the same area multiple times, that's your first clue. Step 2. Watch where buying volume increases. Strong buying activity often confirms support. Step 3. Zoom out. Support levels become much more reliable when viewed on higher time frames, such as the daily or weekly chart. Step 4. Draw horizontal lines across multiple swing lows. If price repeatedly reacts there, you've identified a potential support zone. Remember, the more times a support level is tested without breaking, the more attention traders pay to it. How to identify resistance levels? Resistance follows the same principle. Look for previous price highs, where rallies stopped. Identify areas where sellers repeatedly entered the market. Use horizontal lines connecting multiple swing highs. Check whether volume increased while prices were falling from that level. If several price reversals occur around the same area, you likely have a strong resistance zone. Professional traders rarely treat these levels as exact prices. Instead, they think in terms of zones. Support and resistance become zones. One of the biggest beginner mistakes is drawing extremely precise lines. Markets rarely reverse at one exact price. Instead, prices usually react within a range. For example, support may exist between $98 and $101. Resistance might exist between $182 and $150. Thinking in terms of zones rather than exact prices helps avoid false expectations and unnecessary trades. What happens when support breaks? Sometimes support fails. When this happens, selling pressure overwhelms buyers. The price breaks below support. Interestingly, old support often becomes new resistance. Imagine a stock falling below $100 support. Later, the price rises back toward $100. Instead of buying, many traders sell. The previous support now acts as resistance. This phenomenon is called role reversal, and it's one of the most powerful concepts in technical analysis. What happens when resistance breaks? The opposite is also true. When buyers become stronger than sellers, resistance breaks. After the breakout, the old resistance often turns into new support. Professional traders frequently wait for this retest before entering new positions. This approach helps reduce the chances of chasing false breakouts. Common beginner mistakes. Let's discuss mistakes that many new traders make. Mistake number 1. Buying. Simply because the price touches support. Always wait for confirmation. Look for bullish candlestick patterns or increased buying volume. Mistake number 2. Selling immediately when the price reaches resistance. Sometimes resistance breaks, leading to powerful upward trends. Mistake number 3. Ignoring higher time frames. Support on a 5-minute chart may be insignificant compared to resistance on a daily chart. Always check multiple time frames. Mistake number 4. Drawing too many lines. A chart filled with dozens of support and resistance levels becomes confusing. Keep it simple. Focus only on major price zones. How professionals use support and resistance. Professional traders rarely use support and resistance alone. Instead, they combine them with other tools. For example, candlestick patterns, volume analysis, trend lines, moving averages. RSI, MACD. Imagine the price reaches support. At the same time, a bullish engulfing candle appears. Trading volume increases and RSI indicates oversold conditions. Now several signals align. This increases the probability of a successful trade. Remember, trading is about probability, not certainty. Risk management. Even the strongest support can fail. Even the strongest resistance can break. That's why professional traders always use risk management. Never invest your entire capital in one trade. Always define your stop loss before entering. Protect your capital first. Profits come later. Without risk management, even a good trading strategy can fail over time. Key takeaways. Let's quickly recap. Support is a buying zone where demand often exceeds supply. Resistance is a selling zone where supply often exceeds demand. These levels work because of market psychology. Support and resistance are zones, not exact prices. Always wait for confirmation. Use multiple time frames. Combine support and resistance with other indicators. And most importantly, manage your risk on every trade. Support and resistance are among the first concepts every trader learns. But they're also among the few that professionals continue to use throughout their careers. Mastering these levels won't guarantee winning trades, but they can help you understand where the market is most likely to react and make more informed decisions. If you found this video helpful, give it a thumbs up and subscribe for more beginner-friendly guides on investing, trading, technical analysis, and personal finance. Also, let me know in the comments. Which topic would you like to learn next? Trend lines, moving averages, RSI, MACD, or candlestick patterns? Thanks for watching, and I'll see you in the next video. Disclaimer. This video is for educational purposes only and should not be considered financial or investment advice. Trading and investing involve risk, including the potential loss of capital. Always conduct your own research or consult a qualified financial advisor before making investment decisions.